Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, April 17th, 2024, and this is Blockhead Traders Weekly. In this week's episode, we're going to talk about two topics. The first one is the ever-anticipated halving. It sounds kind of ominous and scary. It's been all over the news, and it is occurring in a cryptocurrency near you. What is it? Stay tuned to find out. Also, we're going to touch on a new financial product that Viper has come across called Homium. It is a very interesting way to tap into the equity of your home if you're in a select criteria of people. So stay tuned to that. But first, I want to give a shout out to our Discord, link in the description below. You can click that, say hello to myself, Viper, some of the other Blockhead traders. We'd love to hear what content you want to hear about and what type of things you like to trade. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, you can pick this up in an audio-only format wherever you get your podcasts. Look for us there. If you can't find us, let us know, and we will get it there. But let's hop to this week's content. Viper, the halving. I don't know what it just makes it sound like some sort of ominous event that is I don't know, like I can't picture it, but just the halving is upon us. The halving is nigh. What is this halving business?
Yeah. Well, the crypto community has really leaned into that feeling. And it's more commonly known as the halvening, which is not a real word. It is obviously the halving, like you said, but I've found myself tripping up and calling it the halvening every now and then as well. But basically, this is a inflation control mechanism for the Bitcoin blockchain, and many other blockchains have adopted the same mechanic. But that is to say, since the very beginning of time for the Bitcoin blockchain network, it was decided that initially, and you're probably going to have to help me out on this, initially a block reward, which is a block reward is when your computer, your miner solves this cryptographic hashing algorithm, you are rewarded to the network, or you're rewarded for your contribution to the network with a block reward, which I think if it was initially 64 or 32 Bitcoins?
It was 50 when I first started. You got a block of 50.
Okay, so somewhere around either 50 or 100, depending on where the initial was. Obviously, easy to look up. Did not do that, but you get this reward. So when Sprocket was mining way back in the day, if he had solo mined a block, he would have received 50 Bitcoins, which, that's pretty ridiculous. And even back then, that was really hard to do by yourself. It very quickly became hard to do by yourself because the more miners that get on the network, there's an algorithm at play that, because this has a defined emissions period, for the inflation of the token. So the more people that are mining, instead of just pumping out money faster and faster, there's a difficulty that kicks in. And so the more people that hit the network, this difficulty gets raised. We actually talked about this way back, somewhere in the archives. But there's a difficulty that raises, and it makes it harder for an individual to mine a Bitcoin or mine a block. And that's just a control mechanism to make sure that the emissions schedule is maintained. And then a key part of that emissions schedule is every 4 years, that block reward gets cut in half. And so that is where we are. I believe this is the fourth halvening event. And it happens. It'll actually have happened by the time you're watching this video. So if the world's still ticking and power's still on, we made it.
Nice. I don't know if this is kind of like the locusts, right? Every so many years you get invaded by locusts.
Yeah, it is. But I thought there were some interesting things about the halving that were worth bringing up. And so I guess before we get to any of your thoughts on it, let's take a quick look and travel back in time here on my chart. And let's look at the previous. Yeah, so this is the fourth halving that we've had. And so what we're looking at is this, some people call it the rainbow chart, but this is basically Bitcoin on the weekly, and this is a logarithmic scale of the entire price. So we have the entire price of Bitcoin. I've gone ahead and marked all of the all-time highs, and generally speaking, we consider a cycle between the halvings, but there's been a very noticeable trend as we approach a halving, and then coming out of a halving, we kind of shoot up and find new all-time highs. Then we hit a bear market and come down, and then we hit another halving, and then we shoot up and go all-time highs. And we've repeated that cycle to similar degrees in every halving, except for this one. So one thing that, the whole history never repeats itself, but sometimes it rhymes. If we zoom into the cycle we're currently in as we approach the current halving, something brand new that's never happened before happened. And that was, we hit our all-time high post previous halving. Then we hit the bear market, and then we've come back, and just before the next halving, we've actually hit a new all-time high. And so now everybody's a scurry of, what does this mean? Are we just going to dump now? And is it a new bear market? And honestly, nobody has that answer. So if anybody says they have the answer, they don't. They're lying. But it is an interesting dynamic of that happening. But the one other thing that I wanted to call out as far as what makes this especially interesting to me is that underlying economics, tokenomics of what's happening here, and why we can be fairly confident that new all-time highs will happen at some point post the halving. Though you can see there have been significant pullbacks just before the halving. So that's also why if anybody's being realistic out there, I mean, we could be about to pull back 30-40% before we go to new all-time highs. Nobody knows, but there's plenty of reason why that pullback could happen. And one of the key reasons, in my opinion, to that happening is you have this consumption, this power consumption. Like, the Bitcoin mining world has obviously become insanely large business. And the math of how many Bitcoins per day right now are emitted, the exact number escapes me, but it's around $62 million worth of Bitcoin are minted every single day. And so that, you can imagine, makes it a very significant business model for a lot of very large scale farmers. That consumes a whole lot of electricity. That has a huge cost to that mining operation. And so one of the factors, again, in my opinion, to this dump that we usually get around the halving is the fact that right now, I believe the latest numbers that I saw was the amount of money that it costs to mine one Bitcoin in electricity, hardware, all that kind of stuff, is roughly around $40,000. So today it costs $40,000 to make one Bitcoin. And so in theory, then, everybody that has mined one Bitcoin at these prices, at $61,000 where we're currently at, they can sell that Bitcoin profitably and cover their electricity costs plus some profit on it, which this is something I'm sure Sprocket can speak to here in a minute, because that was a huge part of his calculus back when we were mining, was keeping track of that electricity cost, the price of Bitcoin, are we above the line, and all that kind of stuff. So it would make sense going into the halving that we get a price dump at least to $40,000, because these miners, they control a significant amount of the market activity. Not all of it, because there's so many players. This is such a global market now, but $62 million a day, and they are not diamond hand hodlers. Like, they are in this for a business. So as long as they can sell profitably, they will. They need to, get all their books in order and all that kind of stuff. So post halving, the math, it'll work out, because post halving rewards get cut in half. So 40,000 to make a Bitcoin today, 80,000 to make a Bitcoin come somewhere on 420. So that would indicate then that, kind of part of that pressure of where we get these surges to new all-time highs post a halving event is the miners stop selling. They are mining. Their mining costs have now gone up significantly. And so there's no profit in selling their Bitcoin. They're tracking inventory, I'm sure. So maybe there's some that they want to sell, whatever. But a lot of them will hold and not sell, which then kind of puts this pressure on the market, and the price goes up, and then they'll resume once it can become profitable again, in my opinion. And in that period, it's interesting because some miners will just shut down. Because you're burning too much electricity. Again, I recall this very vividly from Sprocket's days of mining. There were days where it was hit the power button, like we're shut down because the price is not where it needs to be to make this profitable. So a lot of miners will shut down, and then you can actually see on hash the hash difficulty. There's charts out there that show you what the exact difficulty is right now to solve a block. You'll see the hash difficulty plummet because all of these miners shut down. And again, there's that algorithm that's at play of like, hey, I got a lot less people mining. I need to maintain this rate of production. And then the miners that stick around get more profitable. They get more rewards because it's split between less people, all that kind of stuff. So far from an expert in this, but just something that I've thought was really interesting to think about, that dynamic of the mechanic underlying that's been programmed into the blockchain since Genesis, but then the way we see that acting out and affecting the market as we continue to go forward into these future halvings.
Yeah, the whole concept of the halving piece, as well as the difficulty piece, and the kind of the knock-on supply and demand concepts, I was always pretty fascinated by, to think that, hey, all of this kind of delicate push-pull balance thing was really kind of factored into the original design. I always thought it was pretty elegant. It always reminded me of some of the push-pulls that were designed into, the three branches of the U.S. government, where you got your checks and balances. And it's just an interesting thing with the algorithm and how they calculate it, and then how they adjust the difficulty, where you're basically taking, it always reminded me of the kid who didn't study for math class, and he's got this really complex equation, and you use the old guess and test, like, I don't know, let's try 7 and 54. Nope, that didn't work. Let's try 8 and 92. Oh, yeah, that worked. Which is effectively all these miners are doing, is they're just running these complex algorithms with not knowing what the inputs are going to generate the reward output. And as fast as you can do the guess and test method. And it's just really cool how they can adjust that difficulty to make the modification there.
So, and one other thing that I think is really interesting in this, is there's this thing, obviously Bitcoin is compared a lot to gold, and it's the digital gold and all this other stuff. With this halving that we're having right now, after this halving, there's a metric that I recently learned about, called stock to flow. And basically stock to flow is, like in the case of gold, there's a stock to flow ratio. And what that basically is whatever our current stock of gold, whatever the entire global deposit of mined gold is, how long would it take to recreate exactly what we have today? And that kind of is a measure of scarcity. And I don't know what else it's used for. I'm sure it's used for lots of stuff. But currently, I believe the gold stock to flow ratio is around 80 to 88, and that's years that it would take to mine as much gold as we have right now today. And post this halving, Bitcoin will officially become more scarce than gold in the fact that Bitcoin's stock to flow rate is that to recreate the amount of Bitcoin we have today, post this halving, it will take somewhere around 110 to 120 years to create this much Bitcoin again, which is kind of crazy to think about, even if I have no idea if it means anything, but it's the realization of it's now more scarce than gold, which I'm sure will be a selling point.
So I wonder if that must take into consideration the future halving events and the rate of those, and how it will just get exponentially longer.
Yeah, I was thinking about that as well as I was saying that. I don't know if that's assuming the current difficulty and emissions rate, or if it factors in every 4 years getting less and less. Obviously, Bitcoin is a fixed cap resource. There will be a point in time where there is none left, or at least it's a very, very tiny amount that's emitted. And I don't remember exactly when we're projected to hit that. But I guess technically gold is a fixed cap resource as well, at the rate that it is created in the earth.
Yeah. And actually, I guess Bitcoin, I guess there could be a total fixed. I was like, actually, I don't think there can be a total cap, right? It just keeps diminishing, like have and have and have and have. But I don't think it ever gets to zero, right?
Well, it's fixed in that there is a maximum number in the original blockchain contract or Genesis. So in a way, you're right. It just keeps getting less and less and less, but it will never exceed a certain value. It will. So I guess maybe to your point, it'll be emitting eternally, but it just keeps emitting less and less and less and less, and will never exceed whatever the number is. 20. I don't even remember.
21 million.
There's a fixed 21 million.
Okay, interesting. Yeah, that's kind of neat. I shut my miner off a long time ago because it just wasn't profitable.
Yeah, those 16 Bitcoins that we had, those would have never turned into anything.
Yeah. No, I actually, you were talking about the different splitting and the 50, because it was definitely a block was worth 50 when I was mining then. And I remember you could go out on your own and maybe hit a block, just wandering around. But yeah, we were hitting a block every so many hours, but that was shared among, the thousands of people that were in our mining pool. So we would get, a fraction of a Bitcoin every few hours. Now it must be so minuscule now.
And as I recall, did pooling become a thing after you started, or when you were getting into it? It was already it was very early days of pooling protocols, but was it the norm, or was there a period of time where you started and solo mining was the only thing?
I definitely started solo mining. I won't say that pooling was the norm. I recall they seemed to just be newer and coming out, because for a while I was pretty discouraged. I'm like, this is ridiculous. I mean, when am I ever going to get one? Because it would churn and churn and churn. And then, found, and you just kind of keep wandering around. You get a new set of problems. But it was pretty early because there was a lot of pools. They weren't so easy to get into. A lot of times there had to be somebody that referred you in or let you in, which is kind of crazy because a pool benefits really from the most participants, and who cares how many people jump in or who they are. But yeah, it was different.
It's been crazy to see how it's grown, because I can still reflect back on some of the conversations we had and you trying to explain it. And I mean, like, even to this day, as much as I've dug into this space, there's still so much of it that for a very technical mind like me, it is still so hard to grasp. But way back then, like, I still remember so many conversations, and it just 100% was like, I don't know what, this sounds really sketchy, man. Are you sure?
Hey, people still think that today.
What you're doing is legit. They do. But I mean, then it was like double time. Like, I mean, just not even, to me, it felt like you were selling, you didn't realize it, but you were participating in some DDoS network or something like that, they were like, oh yeah, we'll give you this fake internet money, and you're just mining math problems, but really using you to take down networks and stuff. Yep. Kind of how it felt.
I remember that. Yeah. All right, Viper. So you sent me a link here to look over for kind of the next story that we want to cover, or the next type of thing. And it's pretty intriguing. And to be honest, I really only looked at it for a little bit today. But the concept of it is looking to tap into equity in your home in new ways. So everybody's pretty familiar with HELOCs, home equity line of credits, home improvement loans, things like that, reverse mortgages, stuff where you pull equity out of your home, and then you pay back at a particular rate, or when you sign up for a brand new mortgage, right? That's kind of tapping into the equity of the home that you purchased to finance some of the loan. Well, this is a new concept. The vendor or the product, I guess it's a company that kind of put this idea together. So I don't know what this concept will end up being called. Kind of like you got the home equity line of credit. So this one is actually called Homium. And effectively what it's doing is, let's say your house is worth $100,000. And you're like, you know what, I've got my house paid off, or, I only owe $50,000 on it. And you can take the equity that you have in your house. So let's say our house is worth $100,000. Let's say you owe $50,000 in mortgage, but you have $50,000 in equity, right? Home's worth $100,000, you owe $50K is your equity. Well, what you can do is you can take a percentage of your total home's value. Now, you can't take it out of what you owe a mortgage on, so it has to be on the equity that you control. So let's say you take out a 20% loan. So that would be $20,000. You can do that because you got $50,000 in equity. And what the concept of this is you get that money, but you don't make any payments whatsoever. No interest payments, no principal payments. In fact, there is no interest accumulation at all. The catch is that when you want to go sell your house or refinance or something like that, you're obligated to pay back that loan. Now, the catch here is you pay back that loan at the same percentage of your home's value. So your home was worth $100,000. If your home, when you go to pay it back, was worth $200,000, you owe 20% of your home's value. So in that case, you borrowed $20,000 and you got to pay back $40,000. Now, let's say your home fell. This is, another area where, okay, because what you're doing is you're taking a slice of percentage. So let's say it fell to $50,000, cut in half. You would pay back $10,000 because that's 20% of your home's value. And it's kind of an interesting concept. So Viper, I guess I probably spoiled it because I probably talked about it too much in the intro, but
no, that sums up exactly what it is. And some backstory of why it piqued my interest is, I hope it's been clear anytime I talk about the blockchain space and crypto space and whatnot, way more so than like cryptocurrency speculation and things like that. What really interests me is the way that we can modernize financial instruments to the consumer's benefit, or homeowners in this particular case. That's always been one particular use case of a blockchain that has really interested me. When you have this verifiable, proof of ownership sort of thing, and so in my own story, as far as doing some home improvement stuff, and then having a contractor completely run away and all this other stuff, like it just opened up a lot of thoughts on the situation. And as I approach, I'm not loan free on my house, but I'm in the ballpark where I can expedite becoming loan free. But even still, being 50% or less owing on the house, I'm now to a point, and some of this is also just exposure to the markets and trading and investing in general. I'm to a point where like I see my home value as and I want to word this carefully, as an asset to utilize. And that doesn't mean like taking this money out and just going and blowing it and all this other stuff. Like, I view it similar to how you should view like your 401k or something like that. It is this significant asset, and mostly it's kept out of reach for as a financial vehicle. And what I mean by that is, like you said, there's HELOCs, these home equity line of credits, and ways that you can tap into that equity. That's nothing new. But the problem with, like, you tap into that equity usually for an expense. We'll call it a burn sink, where you take that cash and you go and use it in an expenditure way, where the cash is gone. And so now you're paying back whatever you spent that on, plus interest and all this other stuff. And it's really, I guess, an even simpler way to put it is to tap into your home equity for the use of financial investments, and using that liquidity for that. It's just never a great idea, because you're combating the housing market slightly in today's world. But more than anything, you're combating interest rates on that loan from a home equity line of credit. And interest rates obviously fluctuate. And so it's just really hard to tap into your home equity as a financial vehicle in today's world, because there's so many things pumped against you with interest rates and all that kind of stuff. So this piqued my interest as potentially removing part of that, but it's not a slam dunk of this is awesome for everybody. Like, this is a very specific tool that I think could open up a lot of very neat opportunities as a financial vehicle. So as Sprocket described, I don't view it as particularly helpful it could be, you could, but at a very broad, high level, I don't view it as particularly beneficial if it's home improvement that you're after or something like that. Shopping around different personal loans might get you a better deal for that kind of stuff. Because that could be significant. The housing market can move very significantly. You take it out, you go buy, you go expand your house or do some big renovation that costs $40,000. And now your home price doubles. And now that $40,000 renovation actually is costing you $80,000, and that seems really hard to work out and make it work in your favor. But if you can take that money out and then use it as a financial vehicle, an investment vehicle, where you still have that cash, and now you still need to pay attention to the markets, and you still need to pay attention to the housing market and make sure that whatever you're doing with that cash, if you can stay ahead of the housing market, and then if you're ahead of the housing market and the housing market crashes, like, then you're really looking good. That to me is very interesting, because of just the ways that opens up more dynamic ways to use your assets to your control. So that interests me a lot, especially being in a place where there's still a bit of a housing bubble, though. This particular asset is brand new. It's only available in the state of Colorado, though they are hoping to expand to additional markets throughout the U.S. This year. But, living in somewhat of a housing bubble right now, yes, there's no telling how high it'll go. But if I'm not planning to sell anytime soon, or again, if I can have a plan before even touching any of this, obviously I can't even touch it, not in my state, but if I can have a plan for the investment, and that's where a lot of stuff we talk about on the show with Sprocket's options plays and spreads, and where all this stuff is known and calculated. If you can practice and get into that routine beforehand, then this becomes a really attractive offer to utilize that asset. And again, if you're on a bubble, now you can also at the same time dynamically short your house. You can short the housing market in that example you laid out, where you borrow up here, your house price drops, you still owe the same percent. So at any time you can call it quits by refinancing. So it's not like something that you can just pay as you go, of like, oh, today I want to pay off 0.5%. Like you can't do that because it requires an appraisal, and that's a whole process, and you got to factor those fees in. So at a high level, certainly a DYOR situation. But if you do that research and you take all the risks known, I feel like there's a really nice opportunity, to map out a pretty successful strategy with this, or at least a risk mitigated strategy.
Yeah. No, it's interesting. In fact, the first time I read through it there, I was talking to you and I immediately said, I think I'd do this, but not from the borrower standpoint. I am on the investor side. So I was very disappointed to look into it and find out you have to be a qualified institutional buyer. And I'm like, I wonder how you become one of those. So I look it up, and it's basically somebody that controls at discretionary accounts worth over $100 million of securities. Which let's just say I'm probably like this close, but maybe in 2025.
Just so close.
And I guess I appreciate what they're trying to do because it's cool, it's different, it's new. But I go back, maybe it's just because I'm a cynical, negative individual when it comes to some of this stuff. And my mind always goes to the casino, right? And casinos are a lot of fun. There's a lot of flash, you can have a blast in there. But casinos exist and they stay in business because they know that statistically the odds are in their favor in all of the games that you're going to play there. And it can be fun. And yes, you get these winners here and there, but all in all, the house always wins. And so if you think about that, it's like, oh, look, here's this brand new financial product. I am on the investor camp because they're the ones that dreamed this product up. And I just don't think they'd put a product out there where they're like, yeah, you know what? We're probably not going to make money on this. This is probably really going to be for the homeowners. And history kind of backs it up. Yes, there's bubbles, and maybe that's where you're thinking, yes, we're in a bubble. Because if you get in close to the top of a bubble and it pops, you're basically shorting the value of your home. You can get out of it later, this, that, and the other thing. But look back at all of the historical things that people have written books on. Look at all of the wealthy families that have passed on generational wealth to generational wealth. The key to almost all of it is land ownership, home ownership, asset, like these things. And if you think fundamentally, like, how does this whole world work? There is a finite amount of land. There's a finite amount of homes, but there's an ever-growing population. And so it's tough for me to get on the other end of that equation, knowing that for decades and centuries, appreciation of property values has been a thing. That's what funds governments. That's where your property taxes come from. Your counties exist and can function because of everyone's property values going up and collecting a percentage of that to fund everything. So you got inflation going against you. So I don't want to sound all like boo-hoo-hoo because it is kind of neat, but let's just say like the wind isn't at your back, in my opinion.
Yeah, that's very true. And certainly worth pointing out, especially I like how you said, it wasn't, a coalition of homeowners that forced this into being. It was, I mean, I didn't look too much into the company Homium themselves, but still, for the investors to show up, as those institutional investors, they're not showing up for charity. They're showing up to make some money. So I think it will get more interesting, to your point on being on the investor side. What I'm hoping happens, and they did indicate on the website that it's initially institutional investors, like you said, and then they will expand to accredited investors at some point in the future. And what I'm hoping is that makes sense as a calculated play of institutional investors, people that are managing over $100 million. Like, that's your stability base. That is your building a solid foundation of liquidity to pull these loans out of and things like that. So I'm hoping it's a calculated play to establish that stability first. and then expanding it to accredited investors, and then hopefully being a little more accessible to the rest of us that are not managing $100 million. Because now this is just off the top of my head, not actually thinking through the math, but could it be a viable hedge that, let's say you have your house paid off? So now I do believe you should always borrow less than 50% of whatever your house is worth, because then worst case scenario, if your house is paid off and you're borrowing less than 50%, worst case scenario, when it comes to refinancing, you can break even on the loan itself, though you might lose money intrinsically as how that value changed and all that sort of stuff. But does it feel like a viable hedge to say you borrowed 40%, whatever you borrow, take 20% of it, and if you have access to the investor side, go drop that on the investor side as sort of a hedge to still get some of, or are we just looping here in runaway pointlessness?
I don't know. It's possible. I mean, it's kind of like the whole, like when you have margin on your brokerage account, and you buy treasuries and on margin, and then you only get so much margin impact of that, and it doesn't deplete it. And can you buy more? And I don't know. I mean, I kind of have to go through some of the calculations of it. I speculate what you're going to find is a lot of volatility, and if you loop it, you'll just be kind of amplifying some of that volatility and potential risk, kind of like a feedback thing. I also want to just throw another couple interesting things out there when it comes to new products. Rewind the clocks back to the late 90s. Early 2000s, there was, a couple new products that hit the financial markets. I think adjustable rate mortgage, or ARMs, those were out there. It was going through a period of rate cuts and things like that. And your adjustable rate mortgage said, hey, every so many months or so many years, your mortgage will adjust to the new prime rate. Well, everybody's like, yeah, rates go down, rates only go down. And then rates started going up, and people's mortgages got bigger and bigger and bigger. And soon their interest payments were just ginormous. And let's not forget about the credit default swaps that the institutional banks were doing. Remember, that was an institutional product. Like, hey guys, you know what we're gonna do? We're gonna take this bad debt, we're gonna bundle it with this bad debt, and we're gonna swap this stuff around. I'll sell you this, you get this debt at dirt cheap prices, and everybody leveraged the hilt out of those things. And then we got a little bit of a housing market correction. So, new products can be cool and flashy. But let's see how they play out.
Yeah, for sure. And I'd close it out with two thoughts. One, because it's easy, like with vehicles like this, it's easy to see it and think, yeah, I'm just going to do it because everything retraces eventually. I would highly encourage that thinking to go look at the S&P, to go look at the NASDAQ, go look at these major market indexes, and you tell me where you bought at one point and when it ever retraced back to that point, because it's a knife catch if you're lucky to get back. And that's just the nature of those large cap markets, where it's just up, significant retrace, but probably not back to origin, up, and yada, 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 over a long enough period of time. And this isn't exactly a product that you're going to want to move quickly in and out of, because it requires an appraisal. It requires a closing. Like, there's a lot of fees associated with that it's not just tap this button and we're good to go. So certainly a lot to think about there, and tying it all back to the channel and what we're doing here. If it was available nationwide, and certainly to our Coloradoan viewers, I would say, I mean, I know I personally, like, whenever this is available to me, I'm still not touching it until I have fully verified a strategy, similar to like Sprocket's options plays, where he has this thing down to a mathematical, statistical science of how things ebb and flow in this structured play. I will not be touching it until I have a significant amount of data, multi-years of data of a particular strategy that I can count on it. Because in this particular vehicle, as soon as that cash touches your hands, the clock's ticking. And the clock's ticking on the housing market and keeping up with it at a minimum. And so that's also something to be considering as well. Of this isn't something to like, all right, I got all this money, now what? Like having that plan of either how to get to a point where you can refinance and pay it back, or keep up with the market accordingly. Which anybody that's paid attention to my trading strategies, I am not known for settling into that smooth sailing, tried and true, hit the regimented routine that Sprocket is with his options trades when he gets going on those wheels. So I have a long way to go, but it's happening right here on the channel in front of you.
So that brings us to the end of this week's episode. The halving is just around the corner, and it will have already occurred by the time you hear this video. What will it mean for Bitcoin prices? We'll keep an eye on it, because time is the only way that we will figure that out. And Homium, is this a new financial equity product that you would tap into? Like everything, do your own due diligence. As much as the negativity or bad, rain on the parade that I gave in the episode, I do like it from the investor standpoint, because it does fit one of those philosophies and methodologies that I like, strategies I like to trade, is be the plumbing, be part of this passive thing. So hooking into an equity that largely appreciates over time at a certain percentage of a diminishing resource, like that's interesting to me. And so is it available to everyday investors like me? No, not yet. But with every new technology, the initial things that are out there are always out of reach of the everyday man. But as that technology advances, it starts moving down and making simpler and simpler. And well, today you might require an appraisal, a bunch of contracts and things like that. Someday, evolution in that area could very much make it simple and easier to tap into. Probably almost as easy as it is to get a credit card. Just fill out a couple things, and they have this whole infrastructure lined up to know how much credit they can extend you. And then boom, you got a little plastic card that's got your credit on it. So will it get there someday? Who knows? We'll find out. But like I said, it's all about exploring, looking at different leverages and ways to participate in capital markets in all kinds of new creative ways that aren't the traditional savings account. They aren't the traditional stock always. Yep, that's what we're all about, is exploring and learning. So hopefully you find some of this interesting. Hopefully you're finding things out there for your capital to go into to help build wealth for you and your future generations. And don't forget, think outside the block.